Welcome to Money Daily, a daily dose of financial insight to help you see further ahead. Tesla has just secured two epic victories that could reshape its destiny over the next decade. One in autonomous driving legislation, and another in gaining independence across its core supply chain. When you hear news like that, you'd expect the stock to surge. 5%? 10%? Maybe even more. But the reality is strange. After all these announcements, Tesla's stock barely moved. Just a symbolic fluctuation of around 1%. So what's going on with this eerie bottleneck? Has the market already priced in all the good news? Or is Wall Street collectively holding its breath, waiting for something far bigger? A super event powerful enough to ignite global financial markets? When major positive news hits and prices choose silence, it usually signals two things. First, the market is being overshadowed by a much larger macroeconomic cloud. Second, a deeper pricing distortion may be quietly taking shape. Today, we're diving into the pre-earnings setup for Tesla. We'll break down those heavyweight catalysts that the market has temporarily put on ice, and we'll look ahead to the macroeconomic storm set to sweep across the globe this week. This isn't just about Tesla. It's about how, at the complex opening of 2026, we should understand the pricing logic behind technology blue-chip stocks. Let's start with the first piece of the puzzle, and the one that has the tech world the most excited. A U.S. House committee is scheduled to hold a hearing on January 13th to review a draft bill focused on the deployment of autonomous vehicles. Many retail investors see headlines like this and think, oh, it's just another meeting. Real implementation is still far away. But as an investor, you have to understand every number hidden behind this kind of news. Under the current legal framework, fully autonomous vehicles with no steering wheel and no pedals are capped at just 2,500 deployments per year. What does 2,500 vehicles actually mean? For a company like Tesla, with annual production capacity in the millions, it's not even enough for a proper test fleet, let alone building any kind of commercial loop. It's like inventing a teleporting aircraft, only for the government to tell you that you're allowed to build 10 units a year. The core of this draft bill is to raise that cap from 2,500 vehicles straight to 90,000. And pay attention, this isn't just a 36 times increase. 90,000 is a critical threshold. It marks the moment when robotaxis move from a tech demo into the realm of scaled commercial operations. Once this bill passes, Tesla's Cybercab is no longer just an expensive toy Musk shows off on stage. It becomes a cash-generating machine that can be deployed immediately across major cities. The deeper upside is even more important. The proposal would prohibit individual states from setting their own autonomous driving rules. For years, the biggest obstacle to autonomous driving in the US hasn't been algorithms, it's fragmented regulation. California has one set of rules, Texas has another, Florida has something else entirely. Automakers are forced to customize compliance systems state by state. If federal standards are unified, Tesla only needs to satisfy Washington to operate nationwide. The impact on market access and operating costs could outweigh even technological improvements. For a player like Tesla, already sitting on massive data, a mature FSD system, and real-world deployment experience, this bill looks almost tailor-made. It clears the final and hardest political barrier standing in the way of large-scale deployment. If legislative progress represents an improvement in the external environment,
like the AI and robots to the limit will saturate all human desire.
then Musk's recent hints about building Tesla's own chip fabrication facility signal another leap in its internal core competitiveness. In recent discussions, Musk mentioned a super chip factory and even brought up 2-nanometer process technology. Many people ask, doesn't Tesla already have one of the most powerful in-vehicle chips in the world? Why copy TSMC and build fabs? Isn't that insanely expensive? Here's the key point. In the AI era, computing power is oil, and chips are the refineries. Right now, whether it's NVIDIA or Tesla, final chip manufacturing depends heavily on a very small number of foundries. In a future defined by geopolitical risk and supply chain competition, that dependence is a fatal weakness. Tesla's goal is extreme vertical integration. If you own the autonomous driving software, the FSD neural networks, and fleet-scale data, but your hardware manufacturing is still controlled by others, you'll never reach maximum efficiency or minimum cost. 2-nanometer chips represent the frontier of human semiconductor manufacturing. If Tesla can establish a position here, even partial manufacturing independence would allow it to push FSD chip power consumption to the absolute minimum while multiplying compute performance. That means future Teslas could run far larger vision models locally without a significant increase in energy use. At that point, this is no longer just a car. It's a mobile, high-performance computing center. The market may dismiss chip fabs as just another grand promise for now. But remember, 10 years ago, when Musk talked about building a massive battery gigafactory, the reaction was exactly the same. History shows that Musk's obsession with controlling the supply chain is precisely what has protected Tesla's high margins. Now, here's where things really get interesting. Faced with news that would normally send any tech stock soaring, Tesla's price action has been unusually muted. Does this mean investors have suddenly become smarter? Or are they seeing risks that most people are missing? The answer sits in the broader macro picture. You need to understand one key idea. In today's market environment, Tesla is no longer just a car company. It's a high-beta technology stock. Its valuation is extremely sensitive to liquidity. As long as expectations around Federal Reserve rate cuts remain unclear, even if Tesla announced the discovery of alien technology, big money would still hesitate to pile in ahead of earnings. The reason everything revolves around rate cut expectations is simple: fear of a hard landing. If the labor market doesn't cool gradually, but instead collapses, then even rate cuts might not be enough to save the economy from recession. This creates a painful stalemate. Investors fear inflation staying high, but also fear a rapid downturn. That tension effectively caps upside for the broader market. So the real question is whether the Fed cuts rates in the first half of 2026 or keeps them elevated into the second half. And here's the key point. If the data unexpectedly spikes in either direction, market logic will change dramatically. That scenario would represent exactly the kind of political and economic double disaster the Fed wants to avoid. If the data triggers that fear, markets may panic in the short term over recession risk. But over the medium to long term, it would force the Fed into frequent rate cuts, releasing massive upside for high-growth, high-valuation tech stocks like Tesla. My personal take, though, is that the market's fear may be exaggerated, as it has been many times throughout history. Uncertainty is always most terrifying before it's resolved. Once a verdict arrives, as long as it isn't catastrophic, it often turns into a classic bad news is priced in catalyst. At the same time, when analyzing Tesla, we can't look at Tesla in isolation. We also have to ask, where is market risk appetite right now? Recent market behavior has been fascinating. Semiconductors and software applications remain strong, but this looks more like a defensive form of offense, investors crowding into the most established tech leaders. Meanwhile, consumer defensives, industrials, real estate, and banking are broadly selling off. That tells us capital is exiting traditional sectors and searching for new growth. But because macro data remains uncertain, that capital is still hovering outside Tesla's door, waiting, but not yet pushing its way in at scale. On top of that, political instability in Venezuela and reports of the US seizing a Russian cruise ship may seem far removed from Tesla's gigafactories, but they add to the background noise of global markets. Whenever geopolitical tensions rise, risk assets, including Bitcoin and high-growth tech stocks, tend to come under pressure. We've seen Bitcoin pull back over the past 6 months, from highs around $120,000. That volatility is really a reflection of tightening liquidity at the margins. And because Tesla is often viewed, in some ways, as the Bitcoin of the tech world, its stock price is highly correlated with shifts in risk sentiment. Bitcoin's decline has weighed on Tesla from a psychological standpoint. For real-world investors, logic is used to determine direction, while technicals are used to find entry points. From a technical perspective, Tesla has pulled back about 12% from its recent high, which is a very healthy correction. Remember this number, $421. That's where Tesla's 100-day moving average sits. During the sharp pullback in mid-November, the stock stabilized and rebounded right at this level. As of now, it remains the bull's last line of defense. If a true black swan were to hit and the market were to fully collapse, where would the next support be? The answer is around $363, or even lower. While the probability of falling to that level is extremely small, a rational investor has to leave room for that scenario. However, as we said at the beginning, the market is currently ignoring a massive amount of positive news. That neglect itself creates a spring-loading effect. The more bullish catalysts that build up, the more powerful the rebound once the pressure is released. When we put all the pieces together, a clear conclusion emerges. Tesla is currently in a pricing vacuum. Legislative breakthroughs, technological progress, and in-house chip development, all fundamental drivers, have collided with a macroeconomic inflection point and been temporarily shoved into the freezer. But freezers eventually lose power. And the switch that cuts the power could be this Friday's jobs report or Tesla's earnings release later this month. For rational investors, it's critical to remember this. Volatility is a friend, not an enemy. Volatility is likely to remain elevated for the rest of January, but we must distinguish between destructive volatility and constructive volatility. For Tesla, because the commercialization of FSD has moved from narrative to legislation, this volatility is more likely part of the setup before an upside move. Wall Street's habit of ignoring good news is often where the best opportunities for individual investors are born. While everyone is fixated on payroll numbers and trembling over macro data, they forget to run the cash flow models on 90,000 autonomous robotaxis. That gap in understanding, that's where the profit comes from. Finally, I want to share a personal reflection on investing. In financial news, we're bombarded with numbers every single day. But behind those numbers is a constant struggle between human fear and hope about the future. What makes Tesla so fascinating is that it's always standing at the center of the storm. Musk is betting on the future of technology, lawmakers are betting on the boundaries of regulation, and we are betting on the market's ability to be rational. Remember this, in the short term, the market is a voting machine. It reflects emotions and biases. But in the long term, it's a weighing machine, and it ultimately weighs real value. Those positive catalysts that are temporarily ignored are like seeds buried under snow. They don't disappear. They're simply waiting for the first rays of spring. In this volatile January, will you let the macro fog cloud your vision? Or can you see through the noise and spot the seed that's already beginning to sprout? As the famous investing quote says, "Be greedy when others are fearful, and fearful when others are greedy." But there's a prerequisite. You must understand why others are afraid and why you have reason not to be. Thank you for watching. This is Money Daily. If you found this video helpful, don't forget to subscribe, like, share, and turn on the notification bell. And feel free to leave your thoughts in the comments. I'll see you in the next episode.